Everyone's heard it. Wait until 70 to claim Social Security to get the maximum benefit. In some corners of the internet, it's almost treated like a financial commandment. But life isn't lived on a spreadsheet. The decision on when to claim your benefits depends on your health, your portfolio, your goals, and even your psychology. Today, I'll break down the common advice, the hidden assumptions, and the real life risks that get ignored. And then I'll show you two case studies that factor in the human side of this decision, one couple who should claim early and another who should wait until 70. If this is your first time here, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. Before we get started, I want to mention that much of this video was inspired by a fantastic research article by Dr. Derek Tharp. I'll leave a link to his article in the description below. With that, let's dive in. When it comes to claiming Social Security, researchers and advisors often default to wait until 70. Why? Because the math says bigger checks for life usually wins out on average. But the research that drives this advice has some shared assumptions baked in. They use an expected value framework as opposed to an expected utility framework, which I'll explain more about in just a moment. They use very low, sometimes zero, for discount rates. And they assume that mortality risk is built into the average life expectancy. And surprise, surprise, with those assumptions, the models almost always say to delay. First, let's explore what those assumptions mean. Proponents of delaying until 70 often use an expected value framework, which means humans make decisions that maximize the expected value of the outcome of that decision. Given the choice between a guaranteed $20 today or a 25% chance at $100, the math says the gamble is worth more, which is $25. But most people would take the $20. Why? Because certainty, timing, and peace of mind matter more than just the math. A more practical framework is expected utility, which is the idea that emotions and psychology, which vary from person to person, play a role in how much a dollar is worth to someone, not just the math. I'll explain how you can factor these aspects into your decision later in the video. Next, let's pause and revisit what a discount rate is. It's just a way of comparing a dollar today to a dollar in the future. Imagine I offer you $1,000 today or $1,000 5 years from now. Most people take it today because inflation erodes value, you can invest it and grow it, and cash now gives you more flexibility. The discount rate is basically the exchange rate between today's dollars and future dollars. The reason the discount rate matters is because if researchers assume a 0% discount rate, they're basically saying a future inflation-adjusted Social Security dollar is worth exactly the same as one today. Their rationale for using 0% is that Social Security is a risk-free, inflation-adjusted stream of income, similar to TIPS, which are Treasury inflation-protected securities, or government bonds, which have recently earned basically nothing after inflation. But if your portfolio can realistically earn 4 to 5% in real returns after inflation, when including your stock allocation, waiting has a major opportunity cost. For example, at a 4% discount rate, $1 5 years from now is only worth about 82 cents today. At 0%, it's still worth a full dollar, and that's a big difference. Now let's look at some of the risks that get ignored when people advocate for delaying no matter what. There's at least 8 big risks. Mortality risk, which is the risk of dying before you break even on your benefit. Sequence of returns risk, the notion that market downturns hit you hardest early in retirement. There's policy risk, rules or taxes could change around Social Security in the future. There's opportunity cost, which we kind of just mentioned. Early dollars received by claiming early could have been invested or spent meaningfully. There's a risk of regret, which is the pain of waiting and then losing out. There's health spend risk, which is receiving money when you may not be able to enjoy it. There's spending flexibility risk, which is the idea that portfolios give options that Social Security can't. And then there's underspending risk. People spend guaranteed income more easily than selling investments. Let's look at an example of that first risk, mortality risk. James is age 61 and single, claims at 62 with a $2,700 monthly benefit. He doesn't need the money, so he invests each check in a 60-40 portfolio that earns a 5% rate of return after inflation. Unfortunately, James passes at age 70, but those Social Security checks would have grown to nearly $400,000. If James had delayed until 70, that money would have simply never existed. So that's mortality risk in a nutshell. When it comes to sequence of returns risk, it's the idea that market drops have the biggest impact in the first 7 to 10 years of your retirement. If you're delaying Social Security, you're pulling more from your portfolio during that fragile period, which exacerbates this risk. To cite another example from Derek's article, let's look at Mike, who's age 62, has $500,000 invested, and a $2,200 monthly Social Security benefit at age 62. If he retired in 2007, just before the '08 financial crisis, claiming at 62 versus 70 kept his overall spending steadier and left him with far more money later because he wasn't forced to drain his portfolio during a downturn and his portfolio was able to recover more effectively. When it comes to policy risk, only 36% of Americans are confident in Social Security's future. Cuts for current retirees may be unlikely, but not impossible. Changes to taxes or inflation adjustments could reduce benefits as well. A 0% discount rate ignores this risk entirely. And then there's opportunity cost. If you're bridging a delay by pulling from a balanced portfolio, your opportunity cost is the return that those dollars could have earned. Most retirees don't fund delays exclusively with tips, like we mentioned earlier. So in practice, a portfolio's expected return, around 4 to 5% after inflation, is the better baseline. And then there's regret, health span, optionality, and underspending risk. Delaying can create regret, plain and simple. Getting a diagnosis at 69 after waiting feels worse than having a smaller check at 95. It can also miss your health span, the years when you can actually use that money for travel, adventure, and memories. And don't forget flexibility. You can't ask Social Security to give you 5 months in advance for a family trip, but your portfolio can. Finally, people spend Social Security more freely than portfolio withdrawals. Delaying often pushes retirees to underspend in their 60s, which is their prime years for enjoying life. So let's bring it all together before we look at the case studies. I think we can all agree that all of these risks are real and should have some impact on claiming Social Security earlier rather than later. To measure that impact, instead of using a flat 0% discount rate, we should start with an opportunity cost of your actual portfolio, say 4% after inflation, and then adjust up or down for risks that matter to you. Let's look at case study number 1 with John and Sarah, who ultimately decide that claiming early is their best option. John and Sarah are both 60 and ready to retire, but they're nervous about doing it without turning on Social Security. They worry about benefit cuts, maybe 10% or more down the road. Their parents all passed away before 80, so longevity isn't on their side. And they love to keep their portfolio flexible so they can travel and help their kids with meaningful gifts over the next decade. They've saved about $500,000 in a 60/40 portfolio, and at 62, they'll be eligible for $5,000 a month in combined Social Security benefits. Their spending target is about $6,000 per month. But here's the catch. If they delay Social Security, they need to cover that gap by pulling directly from their portfolio. So the best way to measure their opportunity cost is by using the expected return of their whole portfolio, which again would be about 4% after inflation. The important part though is that 4% is the starting point, the baseline discount rate that we'll use. From there, we layer in their personal risks, mortality, sequence of returns, regret, health span, flexibility, and underspending, and that pushes their total discount rate much higher. Here's how their personal discount rate adds up. Using the opportunity cost of their portfolio, we'll start with a baseline of 4%, and they have mortality risk. Again, they don't think they're going to live much past 80, so we'll add in 2% to the discount rate for that. They also have sequence of returns risk, which is, again, relying heavily on their portfolio. If a market downturn happens early in retirement, we can add 2% for that. There's a risk of regret, which we can factor in another 0.5%. Health span risk, the same. Same thing with spending flexibility and not having that if they were to delay. All these different risks should have their own percentage that adds to your discount rate. So for their situation, this adds up to a total of 8.5%. At that level, the math flips in favor of claiming as soon as possible at age 62. Now let's look at case study number 2, Steve and Laura. They ultimately decide to delay until 70. Steve and Laura are also 60 and planning to retire soon, but their situation looks completely different. They've saved about $10 million and only plan to spend about $10,000 per month. With that kind of portfolio, they're totally indifferent to where their income comes from, whether it's Social Security or their investments. They'll also be eligible for $5,000 a month in Social Security at 62, but here's the difference. If they choose to delay until 70, they'll fund the gap by carving out a part of their bond allocation into a tips ladder like we mentioned earlier. That way they're not taking on any extra market risk just to wait for the bigger Social Security check. Because they're bridging with tips, their baseline discount rate starts at 0%. Then we look at their personal factors as well. Mortality risk? Sure, it's always there, so maybe a small adjustment up. Sequence of returns risk? Basically 0 for them because they've got plenty of assets and their delay strategy avoids it. Regret, health span, flexibility, and underspending? None of these really move the needle for them because their wealth and mindset makes them indifferent. Where they do adjust is longevity. Steve's father lived to 102, so they've got a strong family history. That pulls their discount rate negative down to around negative 3.5%. And when your discount rate is that low, delaying to 70 becomes the clear winner. So what does this mean? For many retirees, a realistic discount rate when you include opportunity costs and personal risks is closer to 4 to 8%, not 0. That alone can flip the optimal answer from delay to claim earlier. But for the wealthy with tip strategies and longevity on their side, delaying can still be the smart move. The point is, there's no universal right answer. The right decision comes from your health, your goals, your risks, and your preferences. Social Security claiming isn't about squeezing the maximum dollar on paper, it's about building a plan that maximizes your life. If you want us to help you determine how Social Security fits into your overall retirement plan, we'd be happy to chat with you to see if we're a good fit. There's a link in the description below this video that you can use to schedule an introductory call, or you can always visit our website directly at sparkwealthadvisors.com. Thanks for joining, and we will see you in the next video.